Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the week ahead. Today I'm joined by Kevin Cummins, who is our chief US economist here at NatWest, and we're speaking the aftermath of another bumper payrolls report. So the report came in, the US labor market added 147,000 jobs in the month of June, well exceeding expectations of 106, and giving markets a little pause for thought. Kevin, what did you think of this payrolls report? What were your kind of key takeaways?
Yeah, I think the headlines, and thanks for having me today. I think the headlines, as you said, were surprisingly strong again, and lends some support to the idea that the labor market, while it's cooling in the U.S., has remained incredibly resilient despite the heightened level of uncertainty for the outlook here so far this year. So, kind of digging a little bit into the numbers. I mean, if you look at overall payroll growth, you're averaging in and around 150 or so thousand jobs, and that's certainly more than sufficient to keep the unemployment rate at full employment. It's probably somewhere a little bit below that, so that perhaps there's a little bit of downward push on the unemployment rate. And in fact, we saw that this month where the unemployment rate fell, and despite expectations for a mild increase, it actually fell from 4.24% to 4.11%. And the reason it dropped were for the right reasons. So net, it was a better than expected report.
And Kevin, what really stood out to me was that ADP completely got it wrong. They actually forecast an outright decline in private payrolls of 33,000 in the month. So really a complete divergence to the eventual figure we got from the BLS report.
Yeah, I agree. I mean, the ADP data have been pretty unreliable when they release their data, typically 2 days ahead of the employment report. In this case, 1 day, given the 4th of July holiday here in the US, and BLS releasing the data a day earlier than normal. But they've very much have missed the boat on extrapolating what the ADP data are, the private sector ADP data are relative to the BLS private payroll series. This morning, as we mentioned, overall payrolls surpassed expectations, but I have to say the private payroll series underperformed a little bit relative to expectations. So we had looked for a gain of 105,000 in overall payrolls, but 110,000 in private payrolls. And what we actually saw was some moderation and some further slowing in the pace of private sector job growth. So when looking at the details, it was fairly broad based amongst industries, but one industry in particular showed a pretty dramatic slowing was the healthcare sector. And despite what we think is probably some cyclical slowing in the economy, this is one sector that we think is going to remain pretty strong given the aging population in the US. So I wouldn't necessarily extrapolate the sort of slowing that we saw this month going forward in that healthcare sector. That slowed from 69,000, adding 69,000 jobs in May to adding only 39,000 in June. I would imagine it's probably monthly noise, and we'll see some revisions perhaps in the next couple of months that potentially could push that number up a little bit for June. But I would think that I wouldn't necessarily extrapolate that rate of change of slowing going forward. So, it seems like even though we did see some slowing in June, the pace of private sector job growth is still running at a very decent clip here so far this year. And if you look at the hours data within the employment report, that too is a little bit on the softer side relative to expectations and to where we've been. And it's kind of hard to judge. They don't published data on an unrevised basis, or unrounded basis. So we did see it tick down from 34.3 hours to 34.2. And if you incorporate that private sector job gain, we actually saw aggregate index of aggregate hours falling 0.2 on the month. And if you look at where you are for the second quarter versus where you are for the first quarter, to try and come up with a proxy for overall economic activity, you're up at a 1.8% annualized rate in the second quarter. And that's not too far different than what we think the underlying GDP data suggests, about 1.5% for Q2. So, of course, that doesn't include productivity, so you have to kind of lop in some sort of assumption there. But it does suggest that the economy is still growing at a pretty decent trend-like pace for the time being. Now, going into the back half of this year, into the second half of the year, we do have GDP, top line GDP slowing. So it would be consistent with the idea that, we ended the second quarter, when you just look at hours worked and some assumption for productivity growth, you probably are going to see some slowing in the back half of the year. We have about 1.25% top line GDP, mostly reflected in consumption growth slowing. So despite the fact that today's labor data, beat expectations, there's been some indications that consumer spending has slowed a little bit. Earlier this week, we got some data on car sales, light vehicle sales from automakers, and they signaled in June, which is really the only spending data that we have so far, auto sales slipped a little further after falling in May. So that we'll see how retail sales come in, but at least the auto portion is probably a little bit softer. And I think that, in anticipation of today's surprisingly strong result, I think going into it, market participants as well as economists were kind of thinking that we'd see more slowing in job growth than what we had been reported today. So, it was led by weaker consumer spending, I think, expectations. And just, the last week, for instance, we had some downward revisions to Q1 GDP, that consumption was cut to barely positive in the first quarter. And the rebound that we're likely to see in the second quarter, after the data that we had last Friday on personal income and spending, were pretty weak. So I think going into today, markets were expecting, a pretty soft report. And instead, it was fairly solid for the most part. As I mentioned, we did have that pullback in hours and some slowing in private payrolls. But I think the overall trend in the labor market is still very solid. So, from the Fed's perspective, this was certainly a sense of relief, I would think, if you were Chair Powell looking at the report today.
Yeah, definitely. I feel like he needs all the support he can get these days. But it's an interesting dynamic that you mentioned, that actually private payrolls were quite weak in the overall report. So it must have actually been the government sector, the public sector, that picked up the slack. What exactly was the dynamic in terms of government jobs?
And I don't want to overemphasize how much weakness there was in private payrolls. I mean, it's the softest one since, I believe it was last October, the softest print. But these numbers do bounce around on a month-to-month basis. That if you look at the underlying trend, it's still pretty consistent with a solid labor market, is the characterization that Powell uses when he describes the labor market. But similarly, if you look at the state and local sector, that showed incredible strength, particularly at schools. So education services showed a big bounce in June. And, that sort of strength, I'd probably fade a little bit, because there's a lot of seasonality at this time of year because of schools coming to an end of a school year. Sometimes the seasonal factors don't properly adjust for the current school year's closings as far as, start of summer. So I wouldn't emphasize that, the government sector is going to see this renewed, strength going forward. We could see some payback in the coming months with regard to those, seasonal layoffs and so on, school-related employment. That headline was boosted by the government sector, as you properly suggested. The federal government did continue to show declines in overall employment, falling 7,000 in June, while the state and local showed pretty robust gains, particularly amongst that education services. So at the state level, I think you added 40 or so thousand jobs for education services, and the local governments added about 23,000, I think, on the month. So that accounted for the lion's share of government employment in June.
And I guess wrapping all this up, what does this mean for the Fed outlook? We talked about, Powell getting some support from this data. How does it change or not your view?
Yeah, so I think at the end of the day, like I said, I think it's a sense of relief, probably, given the worried anticipation and all the pressure that Powell is feeling to lower rates here going forward. But I think it's probably more of the same from his perspective, that as long as the labor market isn't collapsing and is cooling and is moderating relative to earlier levels, and with the unemployment rate now down all the way to 4.1%, which is below their estimate of where the NARU is, at like their estimate is 4.2, they can remain on the sideline and see how things unfold with regard to inflation. Because while inflation in the last few months, I think the last 4 months, has come down quite nicely, even more than they expected, there's this level of uncertainty with regard to tariffs that are likely to push inflation higher. So, we just saw the Fed's summary of economic projections, which showed inflation by the end of this year moving higher. In our own forecast, they're about 3%. If you look at core PCE prices, and the Fed's pretty close to that as well. So, while it has come down and has come down to about 2.5% on a year-over-year basis, those data are likely to start pushing higher as we go into the autumn after the summer. So I think Powell has said very clearly that he wants to see, and he expects to see, some of the tariff impact within the inflation data over the summertime, that he can make a better judgment whether or not further renewed easing is necessary in the near term, or if it's just better that they remain slightly restrictive here because inflation starts to move away from their 2% objective. So our own forecast is that we are not looking for any rate cuts, which is kind of out of consensus view. But the Fed's own forecast, which is a pretty even split amongst officials, and the dot plot in June did show a wide variety of options going forward. But the median dot does show 2 rate cuts. So, looking at the reaction in markets today after the latest jobs data, going into the report, the question was, will it show, renewed weakening here in hiring? And, the market has very much priced out the possibility that the Fed could cut rates as early as July, as a couple of Fed governors have been on the out in the press advocating for. While I think the large majority of Fed officials are probably a little bit more reluctant to cut rates until they see the inflation data. So I think, September is certainly on the table for the first possibility of a rate cut. But we'll see. We'll see how things evolve over the summer.
Yeah, well, I guess the market right now is pivoting more towards your view. So it certainly seems like that's on the table. I do think it was interesting that, we had the markets fully pricing out July. We had this big move up in the dollar. But, as we're speaking, the dollar is almost completely reversed it. I think it goes to kind of the FX view that, there's more behind this long-term dollar downtrend that we're calling for. So, things like reserve diversification and the end of US exceptionalism, more global certainty over US trade policy, and just long-term very stretched dollar valuations that really underpin our call that the dollar could continue to sell off. And obviously that kind of creates a more optimistic backdrop for emerging markets assets. And we at NatWest are calling kind of for some of the high carry EM currencies to really outperform in this environment as long as risk really holds up. Well, Kevin, thank you so much for taking us through all the detail with the non-farm payrolls report. That about wraps it up for today's session. If you did like the podcast, please do like and subscribe. Thanks again for joining us.